All right, welcome everyone. This is our typical Wednesday afternoon sales session where we go through a topic or two, whether it's a product, a concept, or something along those lines in the insurance industry. Today, we're going to talk about, will interest rates ever go up? And I bet you guys probably get that from your clients as well. A lot of times you'll probably decide whether or not you should purchase a financial or insurance product right now, or possibly wait because insurance rates may go up in the foreseeable future. We'll see. So why don't we jump right in? Let's take a step back. What are interest rates? In general, interest rates are the cost of borrowing money, usually from one bank to another. Different banks need to hold a certain number or certain amount of money in reserves. And a lot of times when maybe one bank has a surplus and one bank is maybe loaned a little bit too much out to, say, an individual or a business or something, they're going to borrow money from one bank to another. And the Federal Reserve are the ones that set the interest rate between banks. And banks, I mean, they send millions and billions of dollars overnight to each other because of the cash reserve standpoint. And what happens is that there's sort of a trickle down effect in that you get the Federal Reserve, the rate, and then from there, eventually comes what the mortgage rates are, what, say, a savings rate is, what CDs are, what the 10-year treasury is. So everything starts with the Federal Reserve rates of how much banks will pay when they loan money to each other. So that's the first thing I want to get accomplished, is what are interest rates? Now let's talk about why would the Fed change rates, whether it's up or down? The main reason would be to counteract inflation, counteract unemployment, and then finally debt. If the federal debt gets too high or too low, you can see the Fed changing rates, again, possibly for the positive, possibly for the negative, depending on the situation. So we've talked about what interest rates are. Why would the Fed change rates? So let's jump right into what causes interest rates to rise. And there's three main reasons for it. Again, we talked about on the last slide, inflation. If the cost of purchasing a product or a service is going up too fast, if inflation is going up too fast, they may raise the interest rate to counteract that. If the market is overheating, it's going up too quickly, they may raise interest rates to counteract that. Deleveraging. Deleveraging is basically the federal debt having that go down. If it goes down too much, the Fed could raise interest rates as well. And I want to touch on each one of these quickly over the next few slides. So let's start with inflation. What is inflation? It basically comes down to supply versus demand. If there's too much supply, then you're going to see inflation goes down. It's called deflation. Let's take, for example, housing. If there's too many houses on the market and no one's buying them, so there's no demand, what happens to the prices? The prices of the houses actually go down. Where if it's the other way around, where there's too much demand, which depending on let's use housing again, depending on where you are, what region you are in the country, there could be a lot of inflation in housing, where there's just not enough houses on the market compared to the number of people who want to purchase houses. So therefore, the price of houses keeps going up and up. Segmented inflation. This is very much comes into play. Different products or services will rise for inflation at different rates. If you look at, say, disposable goods, let's say milk, bread, butter, they really haven't raised the price on those very much. But if you look, again, depending on the country, up here in New England, from a housing standpoint, there's been a lot of inflation. Or for, let's say, education, for colleges. I mean, inflation, those are going up 6, 7, 8% per year. So inflation is very much segmented depending on whether it's region, depending on whether it's a product or service out there. So that's something to definitely take into consideration when they say that inflation is 1.3% over the last 5 years. That's as a whole. That's not necessarily education or housing, which could be in double digits, but as a whole, inflation hasn't been growing out of control over the last couple of years. What you want to do, lower the demand, put the money somewhere else. So let's say that people are buying too many iPads or phones or stuff like that. So inflation on phones are going up. You know, the cost of buying that iPod or iPhone is going up, 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 up. So inflation is maybe 5, 6, 7% the price every year. What they can do is they can raise interest rates if it gets too much as a whole, raise interest rates so people maybe will decide in their mind, instead of buying that phone that's going to cost me $1,200, I'm going to put it in, let's say, a CD, or even better, a MIGA, a fixed annuity, because interest rates have been going up recently, and they're at the point where it's worth putting that money away compared to buying something, whether it's an iPhone or whatever. So if interest rates if inflation gets too much out of hand, the Fed can raise interest rates to counteract that. So people will stop buying and put their money somewhere else from a savings standpoint. Market overheating, we could be in that right now, where the stock market goes up way too fast compared to what all the experts think it should. So if it goes up way too fast, people think, well, there's eventually going to be a bubble and we're going to have a drop of 10, 20, 30, 40%. So to counteract that, the Fed could also raise interest rates. So maybe people are not continually throwing money in the market, which is pushing the market up. Maybe they take part of that money and put it into a MIGA or a CD or something else, so the market doesn't keep going up and overheats and we have a bubble that bursts. And again, all these reasons, everything is generalization. There's always exceptions to the rule, whether it's inflation, the market, or anything. So the key is, if they're going to raise interest rates, people will take money out of the market. Market will not overheat, hopefully, and they're going to put it in something, CD, MIGA, something like that. And then the final one is deleveraging, lowering debt. And when we say lowering debt, it's in a couple slides moving forward. We're going to get much more into this. But by lowering debt, there's less interest for the government to pay. There's a lower debt to revenue. So if there's a lower debt, then in that situation, there's more money for the government to loan, whether it's a 10-year treasury or, a government note or something like that. So that could end up having interest rates going up because there's less demand, the inverse relationship with bonds and interest rates from there. So again, there's a lot of different ways that the Fed can use interest rates to counteract the different occurrences in the market. Now, the key question that we have, will interest rates go up soon? And I can unequivocally, and this is my opinion, and I'll give you the reasons behind it, I will tell you flat out, will interest rates go up soon? No, they will not. And when I say soon, I'm talking about, we could be talking about 5, 10, 20 years from now. I don't think interest rates will be going up anytime soon. There are reasons for that. Why not? Because of the federal debt, because of deleveraging, like we talked about, lowering that debt, and then finally demographic spending. And I'm going to go into each one of these quickly before we start wrapping things up. So let's talk about debt. What is debt? It's basically taking money from the future and using it today. But the key to debt is that it needs to be repaid with interest. The United States has never defaulted on any of its debt or loans that they have. I'm not saying if they did, it would be good or bad. I'm just saying it hasn't happened. So when we look at debt, the key is how much debt do we have? And in that situation, and I took these numbers actually a few days ago, for those of you who do not know, the US national debt right now is over $28 trillion. Trillion. See, there's a lot of zeros in there. And here's what's even more important. The US federal tax revenue, this is all the money that the US brings in every year, is just under 3.5 trillion. And then you can read it right here. The total interest that we're paying out is 3.8 trillion annually. So think about this. If the government has 28 trillion in debt in the US, and let's say they're paying out on average, whatever that number is, let's say 1.5%. Are they going to raise interest rates to say 3, 4, or 5%? That just means that total interest rate will jump up to like 5 trillion per year. And if we're only bringing in 3.47 trillion per year and we're paying out 5 trillion, recipe for disaster. So because of the amount of debt that we have, that's one of the reasons why we will not be jacking up interest rates anytime soon. The second reason is deleveraging. And when I say deleveraging, I'm talking about federally deleveraging. Deleveraging is just basically paying off debt. And with us individually, as well as with the government, paying off debt is a very good thing. The problem is that there's a difference between individually. If you decide that, hey, I'm going to pay off my credit card debt by the end of the year, that's my goal. You can probably achieve that if you put your mind to it. From a federal standpoint, there are two ways to deleverage at the federal level. You can reduce federal spending or you increase federal taxes. I'm not going to get into a political conversation about this, but suffice to say, there is not the political will right now to do either of these. I know that President has talked about raising taxes. We'll see if that actually does happen. So we're probably going to get to a point, again, could be 5, 10, 15 years from now, where it becomes unbearable in the US to keep that much debt and pay that much in interest. So we're going to have to deleverage. And I think it's going to be a combination of the two. We're going to reduce federal spending. We're going to increase federal taxes. And we're going to have to do something with social programs, whether that's Social Security, Medicare, Medicaid, stuff like that. I absolutely do not think that any of those are going to go away, but I can absolutely see them being tweaked to deleverage, bring down that federal debt. So that's the second reason why I really don't think interest rates will go up anytime soon. And then the final reason is demographic spending. Spending is good. When you spend, when you go out, you buy that iPhone, you buy that new 50 to 60 inch TV, you pay taxes on that. Taxes go to the government. That's part of their revenue that comes in every year. So spending is good for the government. The problem is, who is spending? Young people. Young people want that new shiny thing. Those are the people that are spending in the US. The baby boomers, the people that are 60, 70, 80 years old, they are not spending. They are saving money because, one, they're afraid they might run out of money because they haven't sat down with one of you guys and put together a proper retirement income plan so that they have all of their expenses paid for. So they're saving money just in case. Also, older people are not traveling. They're actually looking to just keep their money and then pass it on to their heirs. Again, who's spending? The young ones are spending. The problem in the US right now is that there are many more baby boomers than there are young people in the US. And that will eventually change, but it's going to take a while. It's going to take a decade. It could take 2 decades. Who knows? So what we've talked about are interest rates, why I really don't feel that you're going to see any interest rates going up anytime soon. And the reason why is because we're paying out more than we're taking in. Also doesn't look like that's going to change anytime soon. There's not that political will in Washington. And then finally, too many people are not spending. The older people are not spending, the younger people are, but there's many more older people in the US compared to younger people. Look at Japan. Japan's the same way, that they have so many more older people who are not spending compared to the younger people. And what this all means is that do not expect any sort of change in interest rates anytime soon. Now, there could be, as you know, interest rates could fluctuate depending on who's buying, who's selling, a little bit. But when we're talking about raising interest rates, we're talking about raising, say, a MIGA, a 3-year MIGA going from 3% to 7%. Something like that, in my opinion, is not going to happen anytime soon. So again, what we wanted to touch on today is interest rates, because your clients are probably coming to you and saying, well, why would I want to lock up my money for 5 or 7 or 10 years if interest rates are going to go up and I can get a better rate if I just wait? You can tell them the 3 reasons. Well, Mr. Client, because of this, this, and this, do not expect interest rates to go up anytime soon. So you may as well purchase it now, get a little bit better rate of return on your money. And then, as I say every single week, and I stress this over and over, leverage DMI. We are here to help. That's our goal. If you make money, we make money. And that's what we're looking to do. We want you to do what's in the best interest of your client each and every time, help them out, and make a good amount of money in as well. So with that said, that's pretty much all I wanted to cover today. So at this point, I'll see, open it up. If there's any questions that you guys have, feel free to type in the Q&A or the chat or however, and we can go from there. So I'm going to take a quick little drink of tea. All right, so it looks like I've either thoroughly confused you guys or I've done a fantastic job of just explaining this. And it looks like Mr. Dandridge has a question. So let's see if we can get him on here. John, how are you?
Pretty good, Jim. How you doing today? I wanted to know, based on what you said,
Yes.
does it impact people's decisions in terms of whether they buy a whole life or a IUL product?
Not necessarily, and again, life is more on Amy's side, but I would say as a whole, people do buy IUL or whole life, not necessarily on what the current interest rate is. It's, those products are transfer of risk products, where with the client, what they're looking to do, they're looking to take care of some sort of need that they have. And while they probably take interest rates into consideration, they're not really, on the life side at least, they're not really going to wait to purchase life insurance, whether it's an IUL, whole life, or whatever, because interest rates are where they are. They're purchasing life insurance because of the coverage or because they're using it as some sort of investment vehicle to, use the cash value in there. So while I think it would come into consideration in their decision, I think there are more important things when they purchase life insurance. Now, on the annuity side, absolutely it comes into play for clients, that say, I get clients tell me all the time, well, why wouldn't I just wait 3 years when interest rates go up and I get a better rate of return. And I usually tell the clients, well, don't expect interest rate to go up in 3 years. It's going to basically most likely stay the same from there. So again, with life insurance, John, I don't see it happening because they're most likely purchasing that for a reason other than interest rates.
Mm-hmm. Yeah, that makes sense.
Yeah, my friend Ted Porter had a question. Why are banking interest rates on CDs, money market accounts so much lower than MYGA rates? Is that just the difference between banks and insurance companies' investment options? Well, yes and no. Ted, that's a complicated question. And I would probably say that the reserves that the banks have to have are a lot higher than the insurance companies have to have. That's one reason. So they have less, so to speak, that is liquid for them to use. Insurance companies are not regulated at the federal level. Insurance companies are regulated at the state level. And because of that, usually the state is, I don't want to say more lax, so to speak, but they have different agendas than, say, at the federal rate. So, again, for me, it more comes down to how much they need to keep in reserves for interest rates. Plus, they use money in different ways. The banks will basically, if they have excess money, they'll loan it to each other, and they'll get that interest rate that the Federal Reserve makes. With insurance companies, they're basically just keeping it themselves and investing that money. So usually they can make a little bit more by investing it than basically loaning it to another bank as well. So that's another reason there. Two good questions.